Hey everyone, and welcome back to the channel. Today, we're diving deep into two giants that probably handle your money, especially around tax season. Intuit, the company behind TurboTax and QuickBooks, and H&R Block, the familiar name with offices everywhere. Think of this as a head-to-head battle, but for your investment portfolio. We're going to break down what makes them tick, how they performed, and which one might be right for your money goals. Visual: split screen with Intuit logo on one side, H&R Block logo on the other. Text: Intuit versus H&R Block. Section 1. Who are they and what do they actually do? First, let's understand their core businesses, because they are fundamentally different. Visual: Intuit logo. Text: Intuit, the tech giant. Intuit is a global tech giant. They're all about software as a service, meaning you pay a subscription to use their products. Think of it like Netflix for your finances. Their main stars are QuickBooks. This is a powerhouse for small businesses, handling everything from invoicing to payroll. TurboTax, their consumer tax preparation software, which many of you probably use. Credit Karma, for managing credit and debt. They've also built this amazing AI-driven Live platform where you can connect with virtual tax and accounting pros via video, disrupting the traditional human-led service market while charging a premium for their software. Visual: H&R Block logo. Text: H&R Block, the hybrid service leader. Now, H&R Block is a bit different. They have a more traditional, hybrid model. They combine a massive physical retail footprint. Imagine about 9,000 offices just in the U.S. Chances are, there's one within 5 miles of you. This builds trust and accessibility. Assisted tax preparation. This is their bread and butter. People go in, an expert helps them, ensuring maximum refunds and audit protection. They also have their own DIY software at hrblock.com to compete with TurboTax, plus services like Spruce, a mobile banking platform, and Wave Financial for micro businesses. Visual: side-by-side comparison chart. Text: Intuit, software and AI. H&R Block, physical and human-led. So, in short, Intuit is the high-tech scalable software company, while H&R Block combines physical trust with digital options. Section 2. Show me the money. How have they grown? Let's talk numbers. We're looking at their performance over the last 5 years, from 2021 to 2025. Visual: upward trending graph for Intuit. Text: Intuit, double-digit growth machine. Intuit has been a growth machine. Their revenue nearly doubled, going from about $9.6 billion to $18.8 billion. That's an 18% average annual growth rate. Their profits kept pace too. How did they do it? Acquisitions. Buying companies like Credit Karma and MailChimp added huge scale. Pricing power. They consistently raised prices on their QuickBooks subscriptions and seen more people upgrade to premium options like TurboTax Live. Visual: stable, slightly upward trending graph for H&R Block. Text: H&R Block, steady and share buybacks. H&R Block, on the other hand, shows a much more stable, low-growth pattern. Their revenue went from $3.4 billion to $3.7 billion, about 2.4% average annual growth. This pretty much matches the overall U.S. tax filing industry's growth. But here's the kicker: even with slow revenue growth, their earnings per share, EPS, basically, how much profit each share makes, grew significantly, about 9% annually. They achieved this by aggressively buying back their own shares. Imagine a pie. If the pie isn't getting much bigger, but you cut out fewer slices, each remaining slice gets larger. That's what they did. Visual: animated pie chart shrinking from 100% to 57% with share buybacks. Text: key takeaway: Intuit is all about aggressive top-line growth and expanding market reach. H&R Block is focused on maximizing cash flow and returning it to shareholders, even with slower revenue growth. Section 3. Profitability. Who's making more from each dollar? This is where their different business models really show. Visual. Intuit bar chart showing growing margins, operating and net profit. Text. Intuit. Scaling SaaS margins. Intuit shows the classic, scalable software profile. As they grow, more revenue drops straight to the bottom line because they don't need a lot of physical overhead. Their operating margins are strong, reaching over 26%, and their net profit margins are around 20%. This is very healthy for a tech company. Visual. H&R Block bar chart showing stable margins. Text. H&R Block. Stable, disciplined margins. H&R Block also has stable and disciplined margins, with operating margins around 21 to 22% and net profit margins around 16 to 17%. They're very efficient with their service model. But then, there's a weird metric, return on equity, or ROE. Intuit's ROE is around 20%, which is good. H&R Block's ROE, however, is astronomical, like 971% in 1 year. What's going on? Visual. H&R Block ROE numbers flashing, then a question mark. Text. H&R Block ROE. What? This isn't a sign of magic or distress. It's a direct result of their aggressive share buybacks. They've bought back so many shares that their shareholder equity, the bottom part of the ROE calculation, has shrunk to near zero and even turned negative. So, the formula goes a bit crazy. It means the metric isn't useful for comparison here, but it doesn't mean they're in trouble. They have plenty of cash and credit. Visual. ROE formula with equity denominator shrinking. Text. Shrinking denominator equals sky-high ROE. Not financial distress. Section 4. Balance sheets and your dividends. Let's quickly check their financial health and how they return money to shareholders. Visual. Simple table comparison. Intuit. Low leverage. Cash. H&R Block. Higher leverage. Negative equity. Text. Balance sheet snapshot. Intuit has a conservative, asset-rich balance sheet with low debt. They generate a ton of cash. H&R Block has a more leveraged balance sheet with negative equity, as we just discussed, but they have strong cash flows and a solid credit line, so they're financially secure despite the aggressive capital structure. Visual. Dividend comparison table. Text. Dividend talk. Growth versus income. Now, for those who like dividends, Intuit offers a lower dividend yield, around 1.25%, but they're a dividend growth stock. They've consistently grown their dividend by about 15% annually over the last 5 years, using the rest of their cash to reinvest in their business. They've increased it for 13 consecutive years. H&R Block is an income-generating powerhouse, yielding between 4.5% and 5.4%. They've paid continuous dividends for 64 years straight, since 1962, and have increased it for 8 consecutive years. Their high yield is very secure because of their predictable tax season cash flows. Visual. Scales balancing Intuit. Growth versus H&R Block. Income. Key takeaway. Intuit is for growth-focused investors who want a growing dividend. H&R Block is for income investors who want a high, stable yield. Section 5. The competition and what's next. These companies dominate their fields. Intuit with QuickBooks has a near monopoly in small business accounting, and TurboTax leads DIY tax. H&R Block leads the assisted tax market with its thousands of offices. Visual. Market share pie charts for DIY tax. TurboTax 60%, H&R Block 19%, and assisted tax, H&R Block dominant. Text, market dominance, but both face challenges. IRS Direct File. The government now offers a free filing option for simple returns, which could cut into their entry-level business. Price sensitivity. Intuit admitted they lost on price to cheaper DIY options for lower-income filers. Shift to DIY. For H&R Block, the long-term trend of people doing their own taxes digitally is a constant headwind. Visual, news graphic. IRS Direct File a threat? What are they doing for future growth? Intuit's focus. Expanding TurboTax Live to capture the huge assisted tax market, leveraging AI across all products, and growing their small business offerings with higher-end solutions. H&R Block's focus. Stabilizing their assisted market share, attracting higher-income clients who need complex help, and benefiting from complex tax law changes that make expert help more valuable. Visual. Two side-by-side charts showing recent Q3 FY26 performance. Text. Q3 FY26, recent performance. Recently, in May 2026, Intuit had strong financial results, with revenue up 10% and TurboTax Live customers growing a massive 38%. However, their stock dropped because they lowered overall TurboTax revenue guidance due to that price sensitivity, and announced a 17% workforce reduction to focus on AI. H&R Block also had a great quarter, beating estimates. Their assisted tax volumes increased, and they successfully stabilized their market share, a huge win after years of losses. They also raised their full-year guidance and authorized more share buybacks. Section 6. The verdict. Which stock is right for you? So who wins this battle? It's not about one being better, but which one fits your investment style. Visual. Scales, one side, growth, with Intuit logo, other side. Income/value, with H&R Block logo. Intuit, INTU, is for growth investors. If you want a tech company leveraging AI, with strong revenue and profit growth. Long-term believers in software and digital transformation. You're okay with a higher valuation and potentially some volatility during transitions. Visual. Pros/cons list for Intuit. Text. Intuit pros and cons. H&R Block, HRB, is for income-focused investors. If you prioritize a high, stable dividend yield and strong cash flow. Value investors. They often trade at lower valuations compared to growth stocks. You appreciate a resilient, defensive business model that returns capital to shareholders through buybacks and dividends. Visual. Pros/cons list for H&R Block. Text. H&R Block pros and cons. Ultimately, both are strong companies, but they offer very different things. Intuit is the high-growth, high-tech train, while H&R Block is the reliable, high-yield dividend payer. Your choice depends on your personal financial goals and how much risk you're willing to take. Thanks for watching. Don't forget to like this video, subscribe to the channel, and let us know in the comments which one would you pick for your portfolio. See you next time.